listening to the Daily Gold Podcast, covering precious metals, the junior mining sector, and global capital markets for intelligent investors. Now, here is your host, Jordan Roy-Byrne.
Hey, everybody. Welcome back to another episode of the Daily Gold Podcast. Thank you so much for joining us today. In this episode, I am going to be chatting with and interviewing Brent Johnson. He's the CEO of Santiago Capital. And I think all you guys out there know him as the Milkshake man. And I'll just mention this about Brent. You know, we started doing interviews, I think 5+ years ago. And at that time, he was bullish on the dollar, bullish on gold, also bullish on U.S. stocks. And so I like to mention, at least for me, I think he was one of the only people who had that combination and got that right in the last 5+ years. So Brent, it's always great to get your perspective, your thoughts on what's going on. And as we get started, I mean, there's more important things we have to talk about with gold and the dollar. But first, let's talk about, or maybe you can talk about, a couple weeks ago, you know, we saw this hubbub in the news. I mean, even on Fox News, they were talking about the dollar losing its reserve status. There were, you know, thoughts of that in other places. And I'm just wondering if you could, at least for the listeners out there who maybe they tend to really buy into that and they're really worried that the dollar could, you know, collapse in the next year or two or lose its reserve status. Maybe you could answer that and just give us a big picture of where the dollar really is, why it's not going to succumb to some of that nonsense.
Right. Okay. Yeah. Well, first of all, thanks for having me back on. It's always fun to talk to you. You know, it's kind of funny because I have for probably 15 years now been a huge gold bull. And there's been various times during that time period where I thought gold would go down, and there's been various times where I thought it would go up. But I've always advocated to, regardless what I think is going to happen in the short term, I've advocated that everybody should own gold in their portfolio, regardless of what I think it's going to do over the next 2 or 3 months, because I think over the next several years, it's going to go much, much higher. And to then also think the dollar was going higher, that it always kind of made confused people, I guess, and led to some interesting conversations. And that's kind of happened again this year. So I'm happy to come on and kind of talk about that. I think the one thing to keep in mind, and again, most people who have, you know, followed our interviews over the years and have listened to me talk over the last several years knows that I'm a big dollar bull. And again, I'm not saying, similar to gold, I'm not saying that the dollar can't go down. The dollar can absolutely go down. The point that I like to make with the whole dollar milkshake theory, and the reason I've pounded the table as hard as I have on the dollar, is I think it's the most underappreciated risk that there is. And I think that there's a lot of people out there who hear that the Fed is going to do this, or the debt's so big they're going to have to print this amount of money, or there's no way we can possibly continue at to be fiscally irresponsible. And as a result, the dollar is going to lose value. And so then they go and they put all of their money in gold, or they put all of their money in gold miners, or, you know, commodities, or some anti-dollar play, because they're fearful that the US dollar is going to, you know, go into hyperinflation. And while I understand if you just analyze the United States and the dollar in a vacuum, that is the conclusion that you come to. So there's nothing necessarily wrong with that particular analysis. The problem is when you don't look at the world as a whole, and if you don't understand that every other country has very similar problems, and in many cases has bigger problems than we do, and at the same time doesn't have near the advantage that the United States does. And when you look at it from that perspective, you start to realize that there's several things that the US has going for it that will allow it, in my opinion, to get away with these crazy policies longer than most people realize. And in fact, despite all the crazy policies, you could even see the dollar rally spectacularly. And that's exactly what we saw last year. And so, you know, bringing it back to now, you know, the dollar had a big run last year. And it's pulled back about 10% since its high last September. Now, I'm not saying that it can't go lower. Perhaps it will go lower. Perhaps the Fed will pivot and they will start printing more money and doing more stimulus, and the dollar will go back to 95 or 90 or whatever it is. If that happens, in my opinion, that's not the end game. That will not lead to a successful de-dollarization by the rest of the world. In my opinion, what that does is it kicks the can down the road 1, 2, 3 years, and then we end up right back where we were last year in 2025 or 2026 or whatever it is. And the reason I say that is let's just go back to 2020 and 2021. The dollar ran up to 102 during the COVID crisis, and then the Fed came out and they did everything imaginable. They did QE, they did helicopter money, they did stimulus, they shut down businesses, et cetera, et cetera, et cetera. The PPP programs, all the bailouts. And despite everything that they did, and even though the dollar fell for about 10% for about a 12-month period, despite everything they did, then it turned around and went to a 30-year high last year. So from the depths of its fall after the COVID crisis, it rose 25% over the next year and a half. That's a pretty big move for a currency. And I think for those who say that now that the Fed may have to pivot again, again, perhaps they will, but that doesn't. The interesting thing is that the dollar going lower doesn't kill the system. That doesn't lead to the Great Reset. That just leads to the continuation of the current system, because the current system needs either a sideways dollar or a drifting lower dollar. The system can't handle a rapidly rising dollar, and that's why you saw all the problems a year ago or even just 6 months ago. So for everybody who sees these headlines and all the announcements that the world's going to de-dollarize and we're no longer going to use dollars, I'm not advocating to just ignore these. I'm not saying they're not important, and I'm not saying that these are things that you can just ignore. What I'm saying is it's much different to say you're going to de-dollarize than to actually de-dollarize. And we can get into the reasons why that is, but the big reason I push back is I see too many people see the headlines and accept it as a given, as opposed to thinking about it critically. So I still think the biggest risk out there is the dollar rapidly rising, whether it's because of a recession, whether it's because of a bank run, whether it's because of a problem overseas. I think it's the most underappreciated risk. I think the sentiment on the dollar is really low. I think the positioning is way off sides. And if we get any kind of trouble, I think the dollar will rally just like it has every other time for the last 30 years whenever there's been some kind of a crisis or a global slowdown. So I know that was kind of a long, rambling answer, but hopefully that kind of set the stage a little bit for our conversation.
Yeah, that was great, Brent. Now, getting into the here and now and as far as the rest of the year, let's think about a potential recession in the U.S. Obviously, the Fed, they don't want to they really don't want to print money or do some form of QE again unless things get bad, and maybe the recession is a precursor to that. But let's just think about, so a recession is possibly coming or probably coming according to some people. So in that scenario, policy is going to have to be eased at some point. That would tend to be dollar negative, but at the same time, going into a recession, likely pulling the rest of the world into it to some degree, that would be dollar bullish. So how do you think about this scenario and the timing of how it could impact the dollar and gold?
Yeah, so I've been saying for since kind of late last year and even into the first quarter of this year that I thought that by the second quarter, or certainly by the second half of the year, that we would have some kind of a meaningful downturn in the risk assets in the markets. And I kind of feel like we will have a revisit of the lows of where we were last September. Now, the first thing I'll say is I'm not certain that will happen. I'm not sure about anything, but that's kind of my baseline of what I think will happen. I could actually sit here and make an argument for why that won't happen, but I actually do think it will happen, even though it's a fairly common view at this point. The one thing I would say, kind of bringing it back to the dollar, is that the reason that they would have to pivot would be a lack of liquidity, right? Or some kind of a liquidity crisis or some kind of a global slowdown or a domestic slowdown. Well, if we're having a slowdown or some kind of a liquidity event, that tends to push a dollar higher. So again, it would be the dollar going back higher that would cause the Fed to have to come in and pivot or do QE or do something to then weaken the dollar. If the dollar just continues to fall, that kind of indicates that there's plenty of dollar liquidity out there. There's not much, scrambling around trying to find them. It's really, really hard to have a credit crisis if there's plenty of dollars out there, right? A credit crisis, kind of by definition, is an undersupply of dollars. And so in an undersupply or a lack of supply or a lack of liquidity, price tends to rise. And it's that rising price, in my opinion, that would cause the Fed to have to come in and do some kind of a pivot. The other thing I would say is that I think a lot of people are of the opinion that Powell got really caught off guard by these issues with the banks and had no idea that raising rates would cause these problems with long duration bonds. And I think that's completely incorrect. I think Powell is well aware that raising rates could have this effect. I think that's in fact why he was doing it. I think he believes that by crushing demand or slowing down the economy, he can then slow down inflation and bring inflation under control. So I don't think that he's stupid. He even wrote about this and talked about this 10 years ago. So the idea that this is like a complete surprise to him is kind of provably false. Now, that said, I don't necessarily think that he is as skilled an operator to be able to pull it off as maybe he thinks he is, right? And so I would attribute any Fed mistakes to arrogance as opposed to stupidity. And so I don't think it's a big, and because I think he still wants to get inflation lower, I expect him to raise rates again next week. I don't think he would be shocked by, asset prices or markets prices turning down. And as a result, I think he will be slower to pivot than many people think. Now, I'm not going to sit here and say that he won't pivot. Of course he will pivot. The whole reason central bankers exist in the first place is to step into some kind of a market event and a lack of liquidity and be the lender or the market maker of last resort. That is their role. So the idea that they won't do it is a little bit silly as well. But I do think that they want to get inflation under control, and with unemployment still relatively low and the markets near their highs and volatility very low, I think he has kind of an open runway to do it. And so I expect him to continue raising rates. Now that, kind of going back to the arrogance as opposed to stupid, I think it's these rate hikes that will lead to this either slowdown, correction, or market event sometime in the second half of the year. If you think about it, the interest rate hikes that everybody has talked about over the last year really only started 1 year ago. We just hit the 1 year anniversary about a month ago of the first rate hike. So a lot of the rate hikes that took place, late last spring and last summer and even into the fall, we're not even up to a year since that happened yet. And oftentimes it takes a year, 9 months, a year, even 18 months for rate hikes to kind of show their way up or show their way into the real economy. So I think, over the next couple of months, a lot of these rate hikes that were done not even a year ago are going to start to show their effect. And I think that's going to have a slowing effect on the economy and on risk assets. And so I am in the camp that we are going to, whether we have a recession or not, or whether they pivot in time, or whether it's a really short recession, or whether it's a deep one, I don't know. But I just don't expect markets to continue to remain at these elevated levels for another 1 or 2 years without some kind of an event along the way. I think for markets to continue to move measurably higher, there's going to need to be some kind of liquidity injection by global monetary authorities and central banks.
Is there a scenario or any scenario that you could think of where we have a recession and the Fed has to print money and the dollar doesn't make some huge move higher? Like, let's think of a scenario where it makes a move higher, but it's not as big as it was in, right before, right during COVID or like we had last year.
Sure, I think that's possible. Again, I think the reaction function of central bankers has gotten faster in the same way that the reaction function of investors has gotten faster. It seems like every time the market dips, investors go in and buy it. Or every time the Fed says they may have to at some point pivot, investors are kind of trying to front run and get right into the markets. And so in the same way that investors' trigger finger has gotten shorter, I think central bankers' trigger finger has gotten shorter as well. So I could see, like I said, the dollar's kind of oversold at these levels. It's sitting on pretty strong support. Positioning is way off sides. Wouldn't shock me at all to see, a dollar rally here back to the 105, 106, 108 level. But then maybe at that point, maybe that's enough that the central banks have to come in, and maybe we get a whole other QE cycle that, kicks this thing down the road 1 or 2 years. The thing that I would caution people about, though, is that Even if we do get a dollar back in the 90s, right? And even if we do kind of have a repeat of the post-COVID years where the dollar kind of fell pretty fast, the argument I was making at that time was that, hey, this is obviously, due to what the central bank is doing and what the Fed is doing. But the reality is the rest of the world's going to have to do the same thing at some point. And when they get into the game as well, there's no external demand for their currencies in the same way that there's external demand for the dollar as a result of it being the global reserve currency. And so when that happens, those other currencies will start to fall even more than the dollar. And that's exactly what we saw happen, late 21 and into 2022. And that's why the dollar went up so much, not necessarily because the US all of a sudden found religion and got, stopped their profligate policies. It's because the rest of the world is in the same boat, and they've got to do all the same things that we have to do. I'll give you an example. A lot of people will say, the U.S. has borrowed too much money. There's no way they can pay off all of this treasury debt, and so at some point they're going to have to go in and do yield curve control in order to keep the treasury prices from completely crashing. And I would say, yeah, that is a possibility. That might happen someday. But you know what? That's already happening right now today in Japan. Other people will say that, if the treasury prices do ever crash, the Fed will have to go in and buy them all. Okay, I agree. That could happen. But you know what? That happened last September in Britain or in the UK. The Bank of England had to go in and bail out the UK gilt market. And so, will we have to go back to dramatically lowering rates and move back to easy monetary policy? Yeah, we might have to do that at some point. But you know what? That's already been the case in China for the last year. So again, it's not a vacuum. The U.S. doesn't operate just in its own little silo. It operates in a big global world. And while, the dollar could certainly fall in the short term, in the longer term, there is so much demand for the dollar. Whether you think there should be, whether you think it's appropriate, it doesn't really matter. The fact is that there's a huge market for dollars outside the United States, and they're hungry for those dollars. And when every time in the last 25 or 30 years, whenever there's been a material slowdown in the global economy or some kind of a crisis, the dollar has risen, and it's because of that global demand.
Okay, Brent, I want to get your thoughts on the very big picture. I mean, I know we've already said you're bullish on the dollar and gold in the very big picture. But one thing I was thinking about in studying various markets and secular trends, secular bulls in the US dollar, they tend to go with secular bulls in US stocks. And now we see gold is really close to this major breakout. And if that occurs, that probably entails, this is not the best sign for long-term returns in US stocks. So then, I mean, in that scenario, how does the dollar fit in? I mean, is this just a new paradigm where the dollar, like you said, can still, I mean, there's still a risk of a, huge move to the upside at some point?
Yeah, well, I think if we get into a global slowdown where equity prices fall, I think that would be accompanied in general with dollar strength. Again, if it's hard to see a global slowdown and kind of a liquidity crisis or a credit crunch, and as a result, economic activity contract if there's plenty of dollars out there. By definition, a credit contraction means there's fewer dollars out there. But it doesn't mean that the dollar can't fall in the short term. And I think that's important to kind of think about what can happen in the short term versus the medium and long term. And I'll give you a very good example. If you go back to 2008, the dollar index was around 80, let's call it. Okay, now since 2008 and everything that came with the financial crisis, and then the Euro crisis kind of in the 2010 and 2011 time period, all the activities from COVID and the negative interest rates in Europe. And you think about all that went on and all the government stimulus, after 2008, we had QE1, QE2, QE3, Operation Twist. We had a number of bank bailouts. We had a number of stimulus plans. We had the COVID stimulus. Again, all of these different programs that the Fed put in place. And despite that, the dollar rose 20%. So, and over that time period, also since the lows of 2008, the dollar went up dramatically despite all of the efforts to keep it low. Over that same time period, gold went up dramatically, right? And over that same time period, equities went up dramatically. So if you look over long time periods, the dollar, gold, and equities going up together, it's actually not that uncommon. It's not that unusual. It can happen. Now, there's very typically in shorter periods of time, when you see the dollar rising rapidly, you will see asset prices coming down, whether it's gold or whether it's the miners or whether it's stocks or other commodities. Because again, when people are trying to get dollars, they sell their assets in order to get those dollars. So under shorter time frames, they typically have a more inverse relationship than over longer time periods. I'm kind of the belief that if we get into another QE cycle, all right, where the Fed and the central banks are providing stimulus, then probably, gold does very well, commodities do pretty well, the dollar probably falls initially. But I think if and when we get into a crisis, like a currency crisis, where all the central banks of the world are having to provide liquidity and everybody's having to do bailouts, I think under that scenario, you're going to see the US dollar and equities rise together. Because I think if sovereign bonds are being sold because nobody wants to any longer own government issued bonds, I think US equities kind of become the new treasuries, because in a relative world, they look pretty good. And so under that scenario, I could see the Dow rising, the dollar rising, and gold rising together. And again, if you look over the last 4 years, since the first time I started talking about this, the dollar has gone up, gold has gone up, and US equities have gone up more than any of the other equity markets around the world. So I think there is actually some evidence that says this can happen. Now, whether it actually will or not, it's any man's guess. But to me, this is the idea that the dollar is just going to get inflated away. It's going to lose global reserve currency status, and all you have to do is get out of the dollar and buy, hard assets. I think that's a little bit. I think that the people who think that that's a given are a little overconfident.
Yeah, I mean, there were even some points, I think, in the 70s where stocks fared well. So I guess, quick follow-up, I guess in that scenario, you would think that the Dow would probably outperform the S&P and the NASDAQ, those blue chip dividend paying stocks. Do you think that's what would happen?
Yeah. That's my play. That's how, I'm not, maybe some of the really big tech stocks would still, get flows just because they're big enough to handle them. But in general, yeah, I think the big Dow blue chip, dividend paying stocks is where I would be concentrated.
Yeah. Okay. Let me turn our focus to gold and kind of the, short, medium, intermediate term, whatever you want to call it. Sure. So, gold got pretty close to having this big breakout. It did make second and third highest weekly closes ever, closed at a monthly new all-time high by a hair, quarterly new all-time high last quarter. But, now it's obviously in a correction. So how do you feel about gold over the next couple months and for the rest of the year?
Well, over the next couple months, to be honest, I'm a little bit hesitant. We kind of had this nice run up and tested, the $2,000 level 2 different times now. We did it late January and we've done it again now. I think probably that we're going to kind of have a pullback into the summer months. But at that point, I think it would probably be a pretty good time if we do get that to kind of add to positions. And that's kind of my game plan at this point. And, I always reserve the right to change my mind. But if you look back, last September was a fantastic time to buy gold. Everything was totally offsides. The dollar was at its high, and you had the Fed starting to slow their interest rate hikes, and you saw central banks from around the world start to intervene in their currencies. And even the COT report last September was very good. And so I thought that was a great opportunity. We've had a good run. We had a good run for a couple months. It pulled back kind of into the end of the year. And then, we've talked about the run it's had this year. Right now, again, at the beginning of March, when all the stuff was going on in the banks, the COT looked really, really good again, especially in silver. I don't know to the extent you follow silver, but both gold and silver looked really good at the beginning of March, and they both had fantastic moves higher in March and into the first part of April. I think now some of those speculators that kind of piled in for those moves need to get cleared out a little bit. And you can even see on the COT report over the last couple of weeks, the commercial short positions are starting to build up a little bit again. I would expect those to kind of continue to kind of build up a little bit, maybe a little bit more. But then, if we get into as these kind of specs get cleared out, and as we get into the summer, if the commercial short position starts to fall and gets back closer to zero, kind of where it was a month or two ago, I think that would be a great time to probably start adding to your holdings.
Okay, great. Brent, before I let you go, would you be so kind to tell our listeners where they could follow you?
Sure. I'm pretty active on Twitter. You can either look it up, it's under @Santiago AU Fund, or you can type in Santiago Capital into the search field and find me. I'm very active there. I do have a show I do with a friend of mine. We do it either once or twice weekly. It can be found on all the popular podcast platforms and YouTube. It's called the at Milkshakes Pod. So milkshakespod.com is the website. @milkshakespod is the Twitter handle, and you can find it again on all the popular platforms. So would love it if people decide to tune in.
And if they'd like to contact you personally, is it okay to give out that information?
Yeah.
Okay.
Yeah, so I have a website that's really pretty basic. All it has is my contact information and a couple of regulatory documents. But if you go to santiagocapital.com, it has a phone number and email address on there. And what I do is I manage money for very high net worth individuals and families, kind of customized portfolios. And so if people are interested in that, finding out more about that, they can contact me for that as well.
Okay, great. And before I let you go, do you have a favorite milkshake flavor?
I'm pretty simple. I just like vanilla with a little bit of malt powder in it, and I'm good to go.
Oh, that's great. I'm a vanilla ice cream strawberry milkshake guy. So love milkshakes. Glad we got that important information. Brent, it's
Absolutely.
Always great to have you. Thanks so much for coming on. Really appreciate it. And let's do this again in the coming months.
Happy to do it. Thanks for having me. I always enjoy talking to you.
Thank you for tuning into the Daily Gold Podcast. For more interviews, editorials, and analysis, log on to TheDailyGold.com. And for premium coverage of precious metals and the best junior mining companies, visit TheDailyGold.com/premium.